Maybe we just get started. So first of all, thank you for all the attendees for taking some time to discuss today and learn about transfer pricing. We love that everyone is so eager for our webinars to continue. We have been having an overwhelming response in terms of registration numbers. So as long as we still have such a high registration number, then we will probably continue with our webinars. So the topic of today is top tips for small multinational enterprises. And I guess one of the reasons why we wanted it to discuss this topic, Hon Chuan was very eager to share some of his views, is because one of the typical questions that we get asked a lot of the times is, okay, in your view, does a small multinational company has to approach TP in the same way that a large multinational company? So hopefully today we can answer that key question, which is the approach the same for small multinational enterprises versus medium or large multinational enterprises, or is there a different approach? Before we deep dive into the topic for today, let me just do a brief introduction for those who are new. We are an advisory firm that specializes in transfer pricing advisory services catered to companies with domestic and cross-border control transactions. We pride ourselves from being practical, proactive, and cost-effective. We have 3 offices. Our head office located in Australia, our 2 offices in Asia, which is Singapore and Malaysia. And from the 3 offices, we cater to the Asia region. We have been in business for about 15 years. So this is our 15-year anniversary, and we're very happy about that, of being one of the pioneers firms who have been working for such a long period of time dedicated to transfer pricing consulting services. We are also happy to contribute in some industry journals. And if you are interested and you want to have a look of some of our publications, you can visit our websites. And then I will move to give a brief introduction, or maybe I will pass it on to Hon Chuan to introduce himself for those who don't know him.
Hi guys, how's it going? Thanks for coming. I'm Hong Chuan, Director of the Transfer Pricing Solutions Malaysia. On myself, I've spent more than a decade providing transfer pricing advice to, companies from small companies to huge multinationals in various jurisdictions. And I guess we have become, seasoned webinar speakers for the past 2 more years, helping companies like yourself just to, share our transfer pricing knowledge and increase the awareness so that, taxpayers are able to, make more informed decision when it comes to transfer pricing. Thanks.
Thank you, Hon Chuan. And myself, my name is Adriana Calderon. I'm the lead partner of Transfer Pricing Solutions Asia and Malaysia and co-founder. So with 15 years plus of experience in international tax and transfer pricing. Prior to working in transfer pricing solutions, I have worked with Big 4 and mid-tier firms in 4 different countries, advising multinational companies. So I think with that, maybe we can move on into our agenda for today. So first of all, we're going to talk and give a brief overview about key aspects of what is transfer pricing, what is the typical approach, what is the key impact for small multinationals, what are some of the common scenarios that we seen and misconceptions, and we'll give a case study here where we will give some of our views, and then obviously what are some of the ways, if any, to reduce compliance costs for multinational companies. So I think with that, I pass it on to Hon Chuan. If you want to start into the main or one of the main key issues that multinational companies have faced in the recent years in the Malaysian transfer pricing context.
Thank you, Adriana. As mentioned by Adriana, the reason why we wanted to present this topic is because there is a surge in queries by SMEs like yourself asking about transfer pricing, which is mainly due to the recent development, and maybe tax agent raising questions to the SMEs regarding the existence of the transfer pricing documentation. Right? You might have heard the first time what's transfer pricing documentation. Now, in the past, transfer pricing awareness in Malaysia has been increasing since the introduction of the Malaysian TP guidelines in 2012. Coupled with the introduction of the transfer pricing declaration in your Form C in the corporate tax return in 2014. But this awareness is mainly for bigger multinationals, which are at that point in time the main target by the IRB. Right now, during that period, we have the lack of penalties, as well as the IRB actually busy targeting the bigger fish, which allowed the SMEs to actually go under the radar, as they deem transfer pricing compliance costs, they're costly and they're not necessary since the risks is low at that point in time. Now, with the introduction and the recent development of with fixed penalties as well as shortened timeline to furnish the TP documentation on request, it's basically a double whammy for SMEs that have not prepared any TP documentation at all. And SMEs are now struggling with this additional compliance and trying to get this done as soon as possible before they get caught with the penalties.
And I think what you bring a very good point, which is the point of visibility that is quite interesting in the context of Malaysia, that regardless of the size of the business, the moment the business has controlled transactions, it will have to disclose them in the Form C of the tax return. Now, that Form C is what the taxpayer lodges as part of the tax computation every year. And interestingly, one of the questions is also whether you have prepared documentation. And that form is something that applies to any company in Malaysia, any Malaysian taxpayer. So, and that's quite different because other countries have taken different approaches where maybe the requirement to complete these forms is based on the size of the business, maybe based on revenue, like some countries do it, or based on the value of the control transactions, like Singapore does it or Australia does it. But Malaysia has taken a somewhat a different approach, and that makes the likelihood of IRB knowing about this transaction higher, because every taxpayer has to disclose it as long as there is control transactions. Now the question is, okay, when is a taxpayer in the territory of transfer pricing, and why is it important? And maybe it would be great, Hongchuan, if you could share a little bit of thoughts, because some of the things that people always ask us is, okay, what are the parameters have to prepare or be in transfer pricing territory? So what is transfer pricing and why is it important, Hongchuan?
Yeah, I think first up is to at least go through the theory part, right? I'll go through it briefly, as long as, first just want to recap on what's transfer pricing, right? Particularly for those that are, they're aware of the existence of transfer pricing, but they do not know what transfer pricing entails, what's within transfer pricing, right? So now, how do you assess whether you are under the purview of the TP rules in Malaysia, right? The first condition is controlled parties, right? Meaning related parties within the group. Well, I'll explain the definition of control later. Once you know you have controlled parties, the second trigger point is whether there are transactions both domestic or cross-border, right? So this includes domestic and cross-border. Some jurisdictions only include cross-border transactions, but Malaysia includes domestic transactions as well that have taken place between the controlled parties. Now, if both of these conditions are met, then transfer pricing will apply to you, right? Once you know that it has applied, then the next thing to know is what does TP rules entails, what the TP rule says, right? The bottom line is the TP provisions regulate the price of the control transactions, right? The price of the transactions between your control parties, right? To ensure that the price adhere to the arm's length principle, which is the international standard for transfer pricing. I'll go through the arm's length principle as well in the later slides. Now, then you're wondering for yourself, you would question yourself why the TP transfer pricing even exists in the first place, right? Why? Well, you have to understand the story behind the introduction of transfer pricing. First thing is you have to blame the huge multinationals that exploited the various tax treatments between low and high tax entities, where at that point in time, they manipulated the price to shift profits from a high tax entities to low tax entities, right? Imagine the impact that have been created by a billion-dollar company that potentially ended up paying zero taxes, right? As a group, as a whole, which is much less than the taxes that we pay for our personal income tax, right? So they're not really paying their fair share of the tax at that point in time. Now, with these issues coming in, right, then there are two key issues that have arisen for transfer pricing, right? The first is the substance issue, where profits were shifted, for example, in the shell company with no substance, right? That's where we're trying to tackle the substance or form issue. And then obviously to have a arm's length pricing to ensure that pricing at arm's length between the control transactions. Now, what are the typical transactions that will sort of trigger this scrutiny, right? At least in Malaysia. The first one is intragroup services. I think this is one of the most famous one, where so intragroup services includes your famous management services and support services, where a lot of Malaysian companies has these types of related party transactions in place. Then we have sales and purchases of goods, pretty straightforward. And then financial transactions did not used to be scrutinized a lot due to its complexity. But nowadays, the RRB has the expertise and the database to actually analyze financial transactions, your loans, right? Especially your interest-free loans that you guys would have. I think most of the Malaysian have interest-free loans, which needs to be looked at. And that's where RRB are scrutinizing these financial transactions in more detail. And then lastly, intangible properties are increasingly scrutinized by the RRB, but maybe still less common for SMEs due to the complexity. Having said that, now that we are in a more digitalized economy, right, we can actually see a rise of a lot of startup companies in Malaysia, your tech companies developing software, right, within Malaysia, right? In that sense, you would have IP in place that have been developed, but then these IP would then need to be remunerated appropriately once you have that intangible property in place. So yeah, these are common transactions that will trigger scrutiny.
Thank you, Hongchuan. So maybe let's move on to what is the arm's length principle in Malaysia? What do the provisions talk about?
Yeah. As I mentioned earlier about the arm's length principle, under Section 140A of the Income Tax Act, the arm's length principle applies to taxpayers that have entered into control transactions. Now, what is this arm's length principle all about? Right, the arm's length principle applies to the price of the control transaction, right? So price that is arm's length means the price would have been determined or accepted as if that transaction was made between independent parties under similar circumstances, right? This means that in order for you to know whether your price is at arm's length or not, you need independent third-party data similar to your circumstances as a benchmark for comparison to prove that your related party pricing satisfy the arm's length principle. And what is controlled transaction then within the transfer pricing regulations? What defines control, right? In Malaysia, it is governed under Section 139 of the ITA, as well as the new subsection 5A of the Section 140A, which was added effective 1st Jan 2019, right? So Section 139, it refers to control as both direct and indirect control by way of shareholding control, management control, and on top of these two, you also have relationship between the parties, right? Relationship meaning husband and wife, parent and forebear. Forebear means grandparents or above. Then child and remote issue, which means child and below. So you have your son, then you have your grandson as well. So anything above, below are all captured. And lastly, brother and sisters, right? All these immediate families would have been captured under that relationship control. And then a very important change to the control definition was added to Section 140A, which is subsection 5A, where we have gone from a 50% or more shareholding control to a 20% or more with accompanied criteria, which are provision of proprietary rights for the business. So if you have provision of proprietary rights and 20% more, you'll be defined as a related party, or having influence over business activities. That's one of the main ones. Or the ability to actually appoint one or more directors to the board, right? So with this inclusion, it has really changed the landscape of what we have defined control previously as compared to now, which means that more companies would have been under this purview and would more or less fall under the transfer pricing rules and regulations in Malaysia.
That's very interesting because the criteria is quite broad. I mean, if you compare with some other countries, when the percentages are defined, it tends to be between maybe sometimes some of them 25 or 50, and but it's quite broad, so that's a significant change, I have to say. So maybe let's move on to how these provisions apply to SMEs.
So why? Yeah, a lot of people ask, why does it apply to me? Why does it apply to me in the first place? Well, as we had mentioned earlier, generally most SMEs would have related parties and related party transactions in place, mainly due to globalization, and they exploit the investment incentives in different jurisdictions to gain competitive advantage or keeping up the competition. Hence, they're setting up a lot of entities in various jurisdictions. And an example of this is groups setting up shared service center in Malaysia to provide support services to the group, right? The reason to set up the support, the shared service center is mainly because obviously taking advantage of the lower labor costs as compared to the developed countries. Hence, when you start providing these services and have control transaction in place, then TP will apply to you. And then that's the reason why SMEs actually fall under transfer pricing.
Yeah. I think there is always a question that we get asked, and funny enough, lately we have had quite a few advisory projects where the advice is about whether the company falls within the definition of related party and control transactions or not. So is there a magic way of escaping from TP in your view, Hon Chuan?
Well, gone are the days where M&Es are busy looking for finding ways to actually exploit tax loopholes or arbitrage to escape from transfer pricing and shift their profits. So nowadays, if you look at how tax authorities are refining the transfer pricing rules and regulations, they are actually effectively closing off all these loopholes. And I would imagine with the OECD coming into place and countries following the OECD guidelines, basically you would spend more time finding loopholes than preparing your TP documentation yourself.
And I think another point is like so from a structure point of view, we get sometimes we get asked, okay, is there a particular structure that you can use that maybe doesn't trigger TP? And I think with the broadened definition of what control means, and then having more and more inclusions and reducing, for example, the shareholding percentage, it really leaves with not a lot of room to set up structures that, if there is a common interest, they might end up falling within TP, mainly because the provisions are written in such a way that the control can be exercised directly or indirectly. So the indirect aspect of that provision always makes it really hard to escape from a structure point of view. So, for example, sometimes people ask us, "Oh, what about if I just appoint as a director my wife or my relative or even my friend?" And then the question comes back to, okay, but can you influence that person in such a way that you can control the decisions? And that's where it becomes very difficult, because the provisions includes all these examples to make sure that it's not that easy to set up structures that allow for manipulating prices without being caught within TP. So I think that structure. So, and then another point is that, like, you can have structures where there is different entities that are not part of the consolidated group, but that doesn't mean that you don't have common control or common decision making or common management control. So even when you set up like different groups or different structures, or all being under an individual shareholder or under one director, somehow I will say that in my experience, a lot of the times the taxpayer ends up in TP, and is less frequent the situations where we can conclude that there is no control. I think a lot of the times, if in doubt, we end up coming to a conclusion that there is control, mainly because there is a link that ends up having triggering the control aspect, basically. Okay, so if I'm an SME, Hon Chuan, what is the typical approach that maybe I could take for looking at complying with transfer pricing, or looking at the how do I set up a transaction that complies with TP?
Well, SMEs would generally fall below the threshold to prepare a full TP documentation. So in Malaysia, the threshold is more than 5 million and 15 million worth of related party transactions, right? That's when SMEs can opt to prepare a simplified transfer pricing documentation, which has lesser sections to cover, which ease the compliance burden of the taxpayer, right? Now, the step is quite straightforward. The step is, first is the front end of the analysis, which includes documenting down your business operations, your related party transactions details, along with its pricing policies. And then we added on a high-level function analysis. Now, the simplified TP documentation does not require a functional analysis to be performed, but we believe that a high-level function analysis will support the characterization of the entity for further analysis. Hence, we have that high-level function analysis in there. Now, after you have the front-end analysis, then you need to apply the most appropriate method. The key here is that the difference between full and simplified is that you don't need to go through the selection process, right? You just need to choose the most appropriate method, which I'll go to the next slides, right? After you have chosen your most appropriate method, step 3, which is the back end of the report, which is what we call the reports, which is the economic analysis, where you apply your TP methods to test the arm's length nature of the related party transactions and draw a conclusion as to whether your related party transactions are actually at arm's length or not. Right, that's the 3 steps to go through for simplified TP documentation. Okay, the next, as I wanted to go through, which is TP methods briefly. There are 5 methods that are used universally accepted globally for TP. I'm sure you are all aware about the TNMM, which is the transactional net margin method. Generally, the method that will be scoped in your proposal. And a lot of taxpayers would have thought that transactional net margin method, which involves benchmarking searches, is the only method around to test the arm's length nature of your your related party transactions. But there are actually 4 more methods that you can choose from. The first one is comparable uncontrolled price, which actually compares third-party pricing against your related prices for the same product. Right, this is particularly useful if you have internal data for the same product that can be used for comparison. The other 2 methods are resale price and cost plus, which tests the gross margin level. The only difference is resale price is for distributors, and while cost plus is for manufacturers and service providers due to the different PLIs. The 4th one, less common, which is the profit split method, which can be used by companies that are involved jointly in value creation in terms of intangibles. So as I mentioned earlier, in a digitalized company, if you have a startup company or you have 2 companies that are jointly developing a software, for example, then profit split would be particularly useful in this case to actually come up with the arm's length price or arm's length contribution for the transaction itself. And then the last one is your TNMM, right, which requires a benchmarking search to be performed on and test the transaction on a net level, right? So it's good to go through these 5 methods to ensure that you have assessed all these 5 methods accordingly and then choose the most appropriate one to test.
I think one question here is, under simplified, do I have to go through the methodologies? Is it a requirement under the simplified TPD?
Yeah, so basically selection of methods is foregone. So basically you don't need to actually go through this 5. But having said that, I would imagine you still have to go through that 5 to choose the most appropriate method anyway, just that you don't need to document down the process of the selection methods.
But I guess my question was more whether you have to say the most appropriate or not. The question is more about whether you have to use a method for simplified TPD.
Oh, yes. I mean, I guess that's more on a misconception, right? So basically, you can use other than these 5 based on the guidelines, right? But you have to have a method in your economic analysis to actually test whether your real party transactions are at arm's length or not. Right? That's the main thing, to have these methods in place to test. So having simplified TP documentation does not mean you only have the relevant details of your business operations and related party transactions details and pricing policies. On top of that, you still need a method to actually test it whether it's arm's length.
Yeah, correct. All right, maybe let's talk about some of the key impacts and maybe some of the changes in the penalty framework.
Yeah, so these are the impacts that force the SMEs to actually come to this and to be compliant with transfer pricing. Right? So the impacts are introduction of the penalties for failure to furnish TP documentation, the surcharges for TP adjustments, and of course the TP documentation to be made available within 14 days upon request. Right.
Okay. So there is a delay when I'm moving the slides.
Right. Yeah.
So let's look at the penalties framework and the changes that we have on penalties and timing.
Now, first up, big one, which is the penalty.
Yeah.
Before the 1st Jan 2021, there's actually no penalties for the failure to furnish TP documentation. Now, this is where SMEs tend to wait and see. I'll wait and see whether IRB will come in, and then they react, and when they are starting to get audited, and then they try to rush the TP documentation out when they have that 30 days request. Now they have introduced this penalty for failure to furnish, and it starts from 20,000 to 100,000, right? And also includes prison terms of up to 6 months. Now, as you can see, the penalties are very hefty, right? If you fail to furnish, and you can see the scope or the objective of IRB, right? Basically, they're trying to target those that are not, they were trying to wait and see, and then those that have not prepared at all, right? Generally, you'll be in the SME space instead of the multinationals, right?
Let me just...
Then, to also cover up, so these penalties are already in place for penalty for TP adjustments. I just want to go through it. So where taxpayers did not prepare TP documentation during audit, 50%, and then when there is TP documentation, but then you submit it after 30 days or 15 days, which is new guideline, 30%, or voluntary disclosure, 20%. And then if your TP documentation is comprehensive, of high quality, and prepared contemporaneously and submit within 30 days or 14 days, you get no penalties for TP adjustments, which is quite rare.
This is quite interesting because what it means is that in an audited scenario, if you do have some level of TP documentation and analysis, you are eligible straight away to have reduce or a forego of a surcharge. But if you don't have anything, then already you can be subject to 30 to 50% surcharge on top of your TP adjustment, on top of the penalty for not having the TP documentation. Is quite hefty, exactly. Right? And this applies for any type of taxpayer, Hong Chuan?
Yes, that's correct.
Okay. So maybe you want to talk about the changes of the 14 days versus the 30 days, which was also another change.
Yeah, that's the next one that's also quite big. So before is 30 days upon request. Now, effective 1st Jan 2021, you need to make sure that it can provide your TP documentation within 14 days upon request. That's like 2 weeks to actually prepare a comprehensive, or rather in a simplified way, that has been already justified place within 14 days of the letter being received by you from the IRB. So yeah, 30 to 14 days, that's a huge reduction. And then lastly, surcharges of 5%. So this 5% is like previously, if you have no tax payable, then generally a penalty will not be imposed, or surcharge will not be imposed. But effective 1st Jan 2021, regardless of whether you have losses whether you are actually not paying any tax payables, they will collect upfront that 5% first, regardless. So they take this 5% collected, and then it's for you to then start the audit process and defend yourself, and then go through the process and hopefully come up to a settlement to reduce the adjustments.
So essentially, just to summarize, if I am under audit, I am subject to three different things. One is a potential TP adjustment. Two is a potential surcharge on the TP adjustment of 5%. And if I don't have documentation, another surcharge that can be 30% or 50% of the TP adjustment. Plus, I can have a penalty between 200,000 ringgit and 100,000 ringgit
20,000.
for not furnishing the TP documentation.
Yep.
Okay. That's actually, I have to say, that's quite high because we're talking about surcharge, penalty for not having proper documentation or high quality documentation, plus penalty for no furnishes. So we're talking about three types of penalties.
Yeah, I mean, if you look at this, you know what IRB is doing.
Yeah.
Right. And coincidentally, look at the period, right? This is during the COVID. Right. So basically, they're more or less trying to get more funding back.
Yeah. Fair enough. So what are some of the common scenarios that you have seen in your experience, Hon Chuan?
All right, let's go to the common scenarios that we have experienced so far from the taxpayer's point of view. Right. The first one is IRB will not scrutinize SMEs. I mean, I would assume because of the relative smaller size of the company. But now you have to understand what's going on behind, right? TP has been around for quite some time, right? And most of the huge multinationals would have gone through a TP audit in their business life cycle, and more or less would have a robust TP policy in place, right? Now, with these companies, these big multinationals out of the picture, and the introduction of these new penalties and shortened timeline, you'll be thinking, okay, the IRB will need to have a new pool to target, right? What more than a whole pool of SMEs to achieve their KPIs and obtain funding to recoup back the subsidies and grants that were provided during COVID, right? Coincidentally. Hence, that's why that SMEs has huge risks of getting TP audit at this point in time going forward to 2021. Now, then another one is taxpayers can defend themselves during an audit. A lot of times we have been assured by the taxpayer that they know how to defend their TP position. But the issue is, unless you have personally experienced an audit with the IRB and have the knowledge and expertise to justify your TP position, then maybe that's fine. But most of the time, the defense was more of a operational transfer pricing perspective, right? Instead of a tax TP perspective, which can differ significantly, right? So during an audit, you might have known how to defend, might have your justification, but at the same time, you might have provided IRB more bullets to shoot back at you when you actually say the wrong things to the IRB and provided some information that shouldn't be provided to the IRB in the first place. So that's that risk. Next one is global TP documentation is sufficient for myself, right? To a certain extent, yes. Some of the information within the global TP documentation can be useful if it's related to the Malaysian entity point of view. But the IRB will need to have a localized TP documentation, in particular when benchmarking searches is required, and when it is being prepared, it needs to only include Malaysian companies. we are looking at the Malaysian's perspective, right? So again, you need to reassess and see what are the relevant information that you can actually get leverage from your global TP documentation, and then localize your TP documentation accordingly. And lastly, very famous one, taxpayers, they can prepare their own TP documentation, right? We've gotten this, it's very similar to point 2, where there are times where we have received in-house prepared TP documentation, which maybe had 5 to 10 pages without proper justification. And if that in-house prepared TP documentation were to be provided to the IRB, it's, again, you risk further TP adjustments or even recharacterization of the real buyer transaction that you have, and then risk further adjustments from there as well. So these are the common scenarios that we have faced so far that is quite risky on, in the taxpayer's point of view.
And can we just summarize some of the common misconceptions before we go into our case study and our tips?
Yeah. So some of the common misconceptions that we have seen so far is that, you know, SMEs thinks that TP only applies to huge multinationals. As I explained earlier, as long as you have a controlled transaction in place within the group, you will fall under the purview of the Malaysian TP rules. All right. And then the next one is simplified TP documentation only require a paragraph 11.2 ACD of the Malaysian TP guidelines. Fine. Yep. So basically, what taxpayer does is, you know, they look at the Malaysian TP guidelines, they look at the provisions, and so, oh, okay, ACD are the ones that I need to provide. ACD are organizational structure, control transaction details, and pricing policies. These 3. We call these Domino Effects. So the front end of the report, as I mentioned earlier, the first step, that provides a story of the group and its related buyer transactions. Now, the option is there to relieve taxpayers' burden to disclose more than necessary, but it doesn't mean it just stops there, right? The taxpayers is still obliged to test the arm's length nature of their related buyer transactions, right? As using the transfer pricing methods that I've explained earlier to make sure that they adhere to the arm's length pricing principle. All right. Then point 3, similarly, simplified TP does not need to go through the selection of method process, but taxpayers will still need to apply the most appropriate method to test, depending on the circumstances. If you have selected transfer TNMM, for example, then taxpayers will need to still prepare that benchmarking study and test. Lastly, 14 days is generally not sufficient to prepare even a simplified TP documentation, as it still requires proper analysis to test the related party transactions. You wouldn't want to rush a TP documentation out with no valid justification, right? You will risk providing IRB, again, more information than required or misinformation that will actually risk further TP adjustments.
Thank you, Honchan. So let's talk about some of the minimum requirements or ways that the SMEs can manage their compliance cost.
I guess this is something that everyone is looking at, right? How to actually reduce your compliance costs. Unfortunately, transfer pricing advice or requirements are quite costly in terms of compliance. Now, as I mentioned earlier, always, most of the time, TNMM, which involves a benchmarking study, would have been proposed to test your related party transactions without going through the other methods. A benchmarking study can be costly as it is quite labor intensive, as well as includes, you know, your database costs as well. So it'd be good to actually to assess or reassess what TP methods is actually available. The other four methods that I discussed earlier, what other methods are available that can be used to effectively test the arm's length nature of the transactions, and those can be less costly than a benchmarking study. All right. And then next is group TP policy, right? So group TP policy that has been prepared on a group level, and if it is in relation to your related party transactions, and that group TP policy, I would imagine, has proper justification and proper methods has been used to test these transactions and put that in place into the group TP policy, then taxpayers can use that as a basis and then rely on that group TP policy. But obviously, there are a lot of caveats depending on what related party transactions are there, whether they're looking at providers or recipient point of view. Because if you're looking at Malaysian point of view, you need to have localized Malaysian benchmarking. Right, you can use that group TP policy as a basis. Thirdly, leveraging information from existing TP documentation. So this is another one to actually further reduce your compliance costs, right? So when you know there's an existence of TP documentation, depending on which level, so it can be a TP documentation that has existed with the counterparty. So for example, you have Malaysia, you actually have related party transactions with Singapore, and then you can ask your Singapore entity or Singapore counterparty whether any TP documentation has been prepared in Singapore's point of view. And then from there, you can actually then start leveraging information that are in relation to that particular related party transactions. And then depending again on how the counterparty tests the arm's length nature, you may be able to rely on that study. So it's very much dependent on that related party transaction is all about. And then lastly, of course, you would have, I think obviously the best way is to have the contract plus simplified transfer pricing documentation. But then instead of looking at how to reduce your compliance costs, why not look at how to minimize your penalties, right? If you have your penalties of failure to furnish at 20,000, 100,000, right? Once you have the TP documentation in place, you would have that penalty protection of that 20,000 to 100,000. On top of that, you may be able to minimize your 5% plus the penalty of your any potential TP adjustments that will come your way, right? So that's another way of looking at it.
I think that's a fair point, Honchan, because I think if you need a compelling reason to get budget for this extra requirement, I think by the time you put in numbers the penalty of 20,000 to 100,000 plus 30 to 50% of the TP adjustment and plus the surcharge, I think the overall value of the risk will for sure surpass the compliance cost. That's one thing. And I think the second thing is the responsibility of the director of the company. Because when one signed the tax return, what you are saying is that your transactions are priced correctly under the transfer pricing provisions, and therefore your tax assessment is correct. And that's something that the director of the company signs. If transfer pricing is not addressed properly and there is not assurance that the price in a control transaction have been set up correctly, the director can be responsible for misprice and therefore miscalculation of the tax computation for misprice of the control transactions. So there is an element of responsibility as well to get of the director of the company who signs the tax return, which is why these days all of the tax agents, when they do the tax return, the first thing they do in their management letter highlighting risk is TP, is one of those risks, like sales tax and withholding tax. If they observe, for example, they want to raise issues around withholding, GST, and they will raise now the fact that the company needs to ensure that the transfer pricing is in place correctly, because it's the company's director responsibility to sign off on this. So that's another very compelling reason. So let's look through the example here. Let's assume that we have a company A located in Hong Kong and a company B located in Malaysia, and company A sells to company B product B, and company B buys product B from a third party, and company B sells the product to third party customers. So how would you approach this scenario if this is an SME? What will be some of your pointers on how to address this if we assume that company B has not prepared anything in relation to TP?
Yeah, I think this is one of the examples. I just want to highlight how in the normal circumstances where TNMM is proposed to test the profitability of company B, right? But at the same time, if you don't look at the whole picture, then you may risk having to pay on higher costs and not doing the right thing, using the right TP methods. What I'm saying is that now if you're using TMM to test this profitability, if you look at this example, you would realize that company B also purchases the same product from third-party suppliers, right? That's that third-party internal data in place, independent party data in place that can actually potentially use to actually test the understanding nature of these transactions. And bear in mind that obviously I didn't raise that earlier, but in Malaysia, there's still that hierarchy of methods to be used. Obviously, simplified, you choose the most appropriate. But if you look at the TP guidelines, right, they have a hierarchy of the first three, which is the, your cup, your resale price and cost plus. They are called the traditional transactional methods. And the last two, which is the profit split and TNMM, they are called the transactional profit methods, right? In Malaysia, the hierarchy is that you have to go through whether the first three, the traditional transactional methods, is appropriate before even going to your TNMM, right? So in that case, using this example, you have potential either a cup or a resale price methods that can be used to test the arm's length nature of these transactions instead of going straight to TNMM, right? So that's where you have to reassess and see what avenue you have and what kind of information you have by looking at the fact patterns surrounding your related party transactions and make informed decision as to whether that's the right TP methodology. At the same time, whether there are any other ways to actually reduce compliance costs, right?
Yeah, I think maybe another point just to summarize and add on is basically this company B will have to have, first of all, a contract that is very clear with company A. Then the question is, okay, in that contract, I need to have very well defined what is the responsibility of company B, what is the characterization of company B, and what is the role of company A. And that then will be supported with your simplified TP documentation. And then my simplified TP documentation can have some, as we said, as in step 2 and 3, some overview of the business, the methodologies, and then within the methodologies, your point, which is actually very good, is that you don't necessarily need to go down the path of doing an external benchmarking. You could potentially go down the path of using different ways, such as exploring the comparable uncontrolled price or the resale price. And that will reduce your cost, because then you don't have to go down the path of doing an extensive benchmarking, but you still will be applying proper TP method. And that would be probably a good governance and setup that will ease the non-compliance penalties for the taxpayer. I think with that, maybe we're going to move to questions. One last point that we always say is that transfer pricing is a funny discipline because transfer pricing has a domino effect in a lot of aspects of tax and operation. So from internal point of view, it's worth also looking at this early, because if you don't look at it or you're uncertain about your price and it happens to be that is incorrect, then you will be carrying a snowball that we call the domino effect year after year that can have a direct effect in your tax. So your tax returns will be incorrect. You may have indirect tax issues because if there is sales tax, it could be also incorrect. And then you will have an issue having adjustments in the company that is dealing with you because their books are already closed. So any adjustment will need a corresponding adjustment, and the corresponding adjustment tends to be quite difficult. So if you have concerns of incorrect pricing, it's better to tackle it earlier, so you don't have what we call the snowball or the domino effect, and then having to deploy a lot of resources in resolving all these issues. So by the time you equate your penalties, your time, and the exposure, I think you might have a compelling case as to why it's important to look at transfer pricing. With that, maybe let's move to some of the questions. There is quite a bit of questions in our Q&A chat. So the first one is, if a US company sets up a call center in Malaysia using SDNBH and plans to back charge all expenses to the US company, can they just back charge at cost, or must there be a 5 to 10% margin? If they are not allowed to back charge at cost, it means the SDNBHD will always be in profit position. Is it? Thanks.
This TP advice.
but I guess the point here there is, but I think there is some points that we can just give here. I think first of all, it's not appropriate to just charge cost. If there is a service being provided, there has to be a profit markup. Now, when we come back to the point of like having proper TP documentation and being appropriate to reduce your penalties, if you just put a markup that is bring down of the sky, then you're going to have more problems. Unfortunately, in Malaysia, we do not have indicative markups. So I can tell you anything. I can tell you 20, 30, 50, sure. But will that give you the level of reassurance that you need from a compliance point of view? Probably not. If there was some safe harbor markups in Malaysia that could assist in this respect, like in other countries, then obviously we could have say, yeah, use the margin that is in the simplified, but because it's not, then we cannot tell you whether 10 or 5 is correct, because it's as good as, you know, going to a fortune teller and telling him, can you tell me what the markup is? So unfortunately, the answer to the markup question is yes, you need to, but to set it up, you need to have a proper industry benchmarking, unless you have internal data that supports that markup. Another question, do we have to be consistent with the method chosen across various business models and products?
Yeah, so I guess to answer that question, it very much dependent on what related party transactions we are looking at. So I guess to answer it, you don't need to be consistent. All right. The methods used is very much dependent on what related party transaction you are testing. Right. So depending on the related party transaction, you can use different methods to test different related party transactions or different business model in that manner.
Yeah, that's a good point, because I guess the rule of thumb is if the transaction is exactly the same, then by logic, the method should be the same. But if the transaction is different, or the business model is different, or there are subtle differences that can affect the price, then it can be different. And that's something that needs to be explained in the TP analysis, right? If we do not fall within the threshold, are we still required to prepare TP docs?
Yeah, as you mentioned, if you don't, so the threshold is just a line between whether you need to prepare a full-fledged transfer pricing documentation, or if you fall outside, you still required to prepare a simplified TP documentation. So regardless, when you have a controlled transaction in place, you are required to prepare a TP documentation, either full or simplified.
So I think for SMEs, a lot of the time is they are in the territory of simplified, right?
Yeah.
Okay, someone is saying, we have the 5 method slide again. We will, and after the webinar, there will be a recording being sent, so you can just look at the recording again on the 5 methods. A question that I wish I hadn't seen earlier, which is, what is the IRB?
Yeah, apologies. Actually, IRB is the Malaysian Inland Revenue Board, the Malaysian tax authorities.
And last one, what is the most satisfying TP method using by contract manufacturing?
Most satisfied. Are you going to answer that, or?
Yeah, I guess with the contract manufacturing, you have to first understand what type of inflows and outflows do you have as a contract manufacturing. So for example, are you doing something for third parties, or are you doing something only for related parties? Then if you are providing contract manufacturing service to third parties and related parties, maybe you are in the territory of looking at something like a COP or a cost plus, depending on the pricing. If you don't, then maybe you're looking more at a net cost plus and looking at return on total cost based on the fact that contract manufacturing a lot of the times is understood as a service. There are some practical challenges when it comes to implementation. How do you forecast fixed cost and variable cost and so on? But yeah, so it could be either cost plus with internal data, or possibly net cost plus with external data, depending on how the service is being provided.
Net cost plus meaning the TNMM.
Yeah.
Just in case.
Okay. Yeah. I get your point. Transaction and margin method use it in net cost plus as PLI.
PLI.
Yeah. All right. And I think with that, we are done with the questions, and we are done with our webinar for today. Feel free to follow us on YouTube. We have a lot of content that we have been creating over the years with a lot of interesting information and tips that can help your business. We have a few upcoming webinars. The main one that is coming in August, which we are very excited, is the transfer pricing series with Malaysian Institute of Accountants. We're going to have 3 webinars of 4 hours. Actually, it's not webinars anymore. It's like full workshop of 4 hours each. So check it out in our events page. And if you want to attend, feel free to register. If you want to reach out to us, feel free to write us to our email and visit us on our website, and follow us on all our channels, Instagram, LinkedIn, Facebook, Twitter, YouTube, and any future social media platforms that come, because clearly every time that something comes in, we are there. So thank you very much for being with us this afternoon, and speak soon. Bye.
Thank you. Bye.